So let's talk about something that happens to entrepreneurs all the time. You've got one business that's flying high and another one that's, well, not. You do the logical thing, the helpful thing, and use one to support the other. But what seems like a simple act of kindness can turn into a really costly and totally unexpected tax trap. All right, so imagine this is you. You're the sole owner of two completely separate corporations. You've poured your blood, sweat, and tears into both of them. Okay, so company number one, let's call it Corp A. It's your renovation business, and man, it is crushing it. It's profitable, cash is flowing, it's the golden child. But then you've got your other passion project, Corp B, a restaurant. And yeah, it's struggling. Big time. The margins are just razor thin, and it's burning through cash like there's no tomorrow. So you do the logical thing, right? You take some cash from the successful company, Corp A, and loan it interest-free to the struggling restaurant to keep it afloat. But, despite everything, it's just not enough. The restaurant goes under, and that loan, it's gone for good.
This leaves Corp A in a tough spot. So they do the logical thing and formally forgive the debt. On the surface, it looks like a standard business loss, doesn't it? But this is exactly where tax agencies like the Canada Revenue Agency step in with some very specific and, frankly, counterintuitive rules. The very first concept you got to wrap your head around is something called disposition. See, to the CRA, when you forgive a loan, you're not just wiping something off the books. You are legally disposing of a piece of property because that loan, that right to be repaid, is considered an asset. It's almost like you took a piece of machinery and threw it in the scrap heap. It's a taxable event.
So this brings Corp A to a fork in the road. How do they classify this loss? Is it a bad debt, just a part of doing business? Or is it a capital loss, like an investment that just went belly up? The path they take here is crucial because the rules for each are worlds apart.
Now, your first instinct might be to call it a business investment loss. I mean, it makes sense, right? Corp A invested in Corp B. But for these related, non-arm's-length companies, there's a huge hurdle called the stop-loss rules. And believe me, they are designed specifically to stop these kinds of write-offs dead in their tracks.
So this is the big question, isn't it? Can Corp A actually claim this as a legitimate business investment that just, didn't pan out? Are the tax authorities going to let this fly?
And the answer is a pretty resounding no. Actually, before you can even think about the rules for business investment losses, there's a much more fundamental test that Corp A fails. And it fails because the two companies are related. And this quote right here, this gets to the absolute heart of the tax code's logic. It says that a loss is treated as zero, nothing, unless the whole reason you made the loan in the first place was to earn income from it. It all boils down to the original intent. So the CRA basically has a two-part checklist. First, the purpose test. Was this loan made to generate income? Well, it was interest-free, so that's a tough sell. There was no direct profit motive. Second, the relationship test. Were the companies independent strangers? Nope. Since the answer to both is no, the result is brutal. The capital loss is deemed to be zero. For tax purposes, it's like the loss never even happened. But wait, the story isn't over. On top of forgiving the loan, Corp A also stepped up and paid off some of Corp B's leftover bills to its suppliers. Now, you have to think that paying a direct business expense, that's got to be deductible, right? Well, the rule for claiming a bad debt is actually crystal clear. You can only deduct an amount as a bad debt if you've already included that same amount in your income at some point. Think about it. Since Corp A never booked the money it paid to Corp B suppliers as its own revenue, there's simply nothing there to deduct. So when you look at it from the CRA's perspective, Corp A wasn't paying its own expenses. It was just settling another company's debts. That's not considered an operating expense or a deductible loss. It's treated more like a gift or maybe another infusion of capital into Corp B, and you don't get an immediate write-off for that. So after going through this whole mess, what are the big lessons here? This isn't just a random story, it's a super important warning for anyone who runs multiple interconnected businesses. You can really see how it's a domino effect. The non-arm's length relationship? That's domino 1, it triggers the tough rules. The interest-free loan? That's domino 2, it fails the income purpose test. And that failure knocks over the final domino. The loss gets deemed nil, and poof, it's gone for tax purposes. If this whole scenario proves one thing, it's this: structure is everything. It all comes down to how a deal is set up from the very beginning. And that leaves us with one final crucial question. What if that loan had just charged a reasonable rate of interest?
Could that one single change have prevented this entire disaster? That's a question every business owner needs to ask before a single dollar changes hands.